The 60% surge in oil prices this March is not a singular event, it is the first domino in a multi-layered economic shock that will dismantle household budgets over the next 6 months. As crude benchmarks hit the $109 to $111 range, the true danger lies in the delayed waves of inflation that most will fail to anticipate until their liquidity is already compromised. We are moving beyond the visible $3.88 per gallon at the pump into a deeper structural crisis that demands immediate, data-driven financial restructuring. To grasp the gravity of our current trajectory, we must dissect the global machinery that has ground to a halt in these early months of 2026. If you fail to diagnose the root cause of this financial hemorrhage, you will remain defenseless against the secondary symptoms that follow. The reality is that the geopolitical friction involving the United States, Israel, and Iran has ceased to be a distant headline and has instead become a direct tax on your future. With the Strait of Hormuz facing unprecedented disruption, we are witnessing a supply-side catastrophe that the International Energy Agency classifies as historic in its sheer magnitude. This is the engine of the crisis. When both Brent and WTI crude benchmarks vaulted past the $100 threshold to settle stubbornly between $109 and $111, the global economy underwent a fundamental chemical change. That 60% vertical climb in oil prices during March was not a temporary spike, it was the ignition of a multi-layered explosion that will radiate through your financial life for at least the next 2 quarters. Think of this economic shock not as a single blow, but as a series of heavy curtains falling one after another. Most people mistakenly believe that the reach of crude oil ends at the edge of the gas station pavement. They view energy costs through a narrow lens, failing to see the invisible threads connecting a barrel of oil to the plastic packaging in their pantry, the synthetic fibers in their clothing, and the nitrogen fertilizers required to grow their food. Oil is the hidden ingredient in nearly every physical good you consume, from the kerosene. The initial snare is set within the invisible architecture of your own mind. Behavioral psychologists often point to a cognitive phenomenon known as mental accounting, which essentially functions as a series of internal firewalls within your brain. Most people operate under the illusion that they manage their wealth as a single, fluid reservoir, but in reality, your subconscious partitions your capital into rigid silos. You have a mental drawer for the monthly rent, a separate envelope for the grocery run, a pocket for gas, and specific allocations for entertainment, long-term investing, and general savings. Because of this fragmentation, when a sudden spike in energy costs sets one category on fire, your brain refuses to look at the entire house. It does not perform a cold, calculated rebalancing of your total net worth. Instead, it panics and begins throwing items out of the windows of your other life categories to save the room that is burning. This knee-jerk reaction forces you to sacrifice whatever feels the least essential in the moment. You instinctively stop booking those weekend getaways and start canceling dinner reservations. Small, non-essential luxuries are the first to go, but the damage goes much deeper. The extra capital you intended to funnel into your brokerage account this quarter suddenly vanishes. Those ambitious goals you set to bolster your emergency fund for the year are quietly abandoned. These shifts are tectonic yet silent. The first surge of an economic crisis alters your fundamental standard of living long before you even consciously acknowledge that your strategy has changed. The second surge is driven by the heavy scent of diesel and is hitting your local supply chain at this very moment. Diesel is the lifeblood of the global logistics machine, powering the massive freight networks that transport every perishable item from farm to table. Whether it is fresh produce, dairy, frozen goods, or meat, it travels on the back of diesel. When the price of this fuel skyrockets, the overhead for moving every calorie in the country climbs in tandem. Do not be lulled into a false sense of security if the stickers on the supermarket shelves look the same today as they did last week. Retailers are currently acting as a temporary dam against this rising tide. They frequently swallow these cost increases for a brief window, gambling on the hope that energy markets will stabilize. However, that patience has run thin. After years of relentless tariff disputes, rising input inflation, and the slow strangulation of profit margins, most businesses are operating without a safety net. A price shock that might have been delayed by 6 months a decade ago is now being passed directly to the consumer almost instantly. According to data from Reuters, this energy-driven inflationary pressure is expected to seep through the global economy gradually over the coming months. Market analysts have already observed that the disruption to diesel and jet fuel supplies is manifesting well beyond the borders of the Middle East. Perhaps you feel confident because your weekly food bill has not yet exploded despite the headlines about oil shocks. If so, you are not safe, you are simply witnessing the fuse burning before the blast. The third surge is perhaps the most insidious because it involves a biological lag. Many people fail to connect the cost of their dinner in November to the price of natural gas in April, but the link is unbreakable. Modern agriculture is essentially a process of turning energy into food, specifically through fertilizer. Natural gas is the foundational ingredient for producing ammonia and urea, and the Persian Gulf is the central hub for the world supply. Recent intelligence indicates a massive disruption of fertilizer exports moving through the Strait of Hormuz, resulting in a dramatic collapse of shipment volumes and extreme volatility in global urea markets. Some industry reports are already categorizing this as a de facto fertilizer blockade, with prices for these critical inputs surging by more than 60% in the month of March alone. This means that the harvests planned for later this year are being poisoned by high costs right now. The financial injury is like a perennial weed, it is planted in the spring and only breaks the surface when the seasons change. By the time the full weight of these agricultural costs hits the checkout counter this fall, the average consumer will have long forgotten the geopolitical events of early 2026 that caused them. They will experience the pain without understanding the source. Furthermore, for those looking toward the horizon of summer vacations, the fourth surge is already impacting the sky. Jet fuel has been ensnared in the same supply chain bottleneck. Reuters has highlighted that severe shortages of aviation fuel are one of the primary conduits through which Europe and various other international regions will feel the Middle Eastern shock throughout April and May. The aviation industry operates on a timeline that most travelers fail to perceive, meaning the expensive flight you book in July was actually priced during the chaos of the previous spring. Airlines treat fuel risk like a fixed architectural blueprint. They bake projected energy costs into their schedules and ticket prices months before a plane ever leaves the tarmac. Because these financial commitments are locked in so far in advance, airfares possess a frustrating downward rigidity. Even if the price of crude oil were to collapse tomorrow morning, your summer travel costs would not budge. The expensive boarding pass in your hand is not a prediction of future trouble but a calculated mathematical reaction to a fuel shock that has already been integrated into the airline's balance sheet. Beyond the airport terminal, a far more predatory force is beginning to circulate through the credit markets. At the dawn of early 2026, the financial world was operating under the optimistic assumption that the Federal Reserve would soon provide relief by trimming interest rates. However, by the time late March and early April arrived, that hope had evaporated into a harsh new reality. As reported by Reuters, the persistent energy crisis has forced a radical reassessment of monetary policy, effectively removing any possibility of a near-term rate cut as central bankers scramble to contain the inflationary fallout. Federal Reserve officials are moving with extreme trepidation, acknowledging that the toxic influence of high energy prices takes a significant amount of time to fully manifest in the broader economy. This policy shift creates a paralyzing friction in your daily financial life. If you had been eyeing a new home with the expectation that mortgage rates would soften this year, that dream has just been moved to a much more distant horizon. For those juggling credit card balances, the window of punishingly high interest rates has just been extended indefinitely. The wait for a favorable refinancing opportunity has grown longer, and this uncertainty triggers a specific psychological hibernation. When people lose faith in their future purchasing power, they enter a state of economic stasis. They stop hiring, they cancel home renovations, they defer major equipment purchases, and they put off business expansions. This collective gridlock is dangerous. When millions of households decide to freeze simultaneously, a manageable personal budget tighten transforms into a systemic national crisis. Consider your own immediate reaction when you first saw the headlines about surging oil prices. How many of these cascading failures did your mind actually register? Perhaps you thought about your commute or a single grocery bill, but you likely missed the rest of the machinery. This is a classic cognitive trap known as anchoring bias. Your brain seeks out the most glaring, visible data point. usually the neon numbers at the local gas station, and uses it as a placeholder for the entire global economy. This is like looking at a single cough and assuming the patient does not have a systemic infection. If you can afford the extra $20 at the pump, your subconscious tells you the situation is under control. Meanwhile, the International Energy Agency has classified this disruption as one of the most severe energy security shocks in history, and Reuters warns that this volatility will reignite inflation and stall any move toward monetary easing. We have seen this specific movie before, and the ending is always the same. In 2022, following the invasion of Ukraine, the price of gas was merely the opening act. People complained about the pump, unaware that the shock was already migrating into freight costs, service industries, and every link of the food chain. By the time inflation peaked at 9.1%, the average household was already underwater. The damage to your purchasing power happens while you are still staring at the gas pump, waiting for the numbers to stop spinning. The machinery of the global financial market is already grinding under the weight of these energy disruptions, and your cognitive evolution is the only thing standing between your wealth and a total wipeout. If you believe the current volatility is merely a headline, consider the hard data. The S&P 500 has retreated significantly from its peak in January, while the VIX has rocketed toward the 32 level. According to Reuters, the equity markets are buckling under a trifecta of pressures as investors are forced to reprice the risks of war, persistent inflation, and a Federal Reserve that is no longer coming to the rescue with rate cuts. The Russell 2000, which serves as a canary in the coal mine for credit sensitivity and rising fuel costs, is similarly languishing. Even the traditional storm sellers of finance are offering little comfort. Gold has become a theater of volatility, caught in a tug-of-war between inflation-wary buyers, aggressive profit-takers, and a muscular US dollar. Many amateur investors confuse a safe asset with a stable one, but in a pressurized market, even the safest havens can experience a turbulent ride. Have you ever wondered why a market downturn feels more like a physical assault than a simple math problem? When your screens turn red, your amygdala hijacks your logic and issues a primal command to exit the burning building. This is the biological reality of loss aversion. To your central nervous system, a $5,000 drawdown is not a minor statistical variance, it is a 5-alarm emergency. Behavioral economics proves that the psychological agony of a loss is vastly more potent than the euphoria of a gain. This creates what experts call the behavior gap, the chasm between the returns the market actually delivers and the meager portion investors actually keep because they buy when they feel comfortable and sell when they are terrified. But here is the irony of the financial trap: the exit door usually slams shut just as the recovery begins. Historical analysis of market cycles repeatedly confirms that the most explosive gains are often huddled right next to the most brutal sell-offs. During the chaos of March 2020, the crash was lightning fast, but so was the rebound. Those who obeyed their survival instincts and liquidated their holdings spent the rest of the year waiting for a sign of certainty that never arrived, while the recovery surged ahead without them. If you miss even a handful of those powerhouse sessions over several years, your long-term wealth will effectively disintegrate. The market has no obligation to wait for you to feel safe. Currently, the most terrifying specter for analysts is the rise of stagflation, a toxic cocktail where inflation remains stubbornly high while economic growth begins to wither. This environment is a nightmare for policymakers because the cure for one side of the equation inevitably poisons the other. If the Federal Reserve raises rates to kill inflation, they risk crushing what little growth remains. If they stimulate the economy, they pour gasoline on the inflationary fire. Fed officials are already signaling that they are backed into a corner. Understanding that your own brain is prone to overreacting in this environment is the first step toward avoiding a permanent financial scar. The Federal Reserve currently finds itself navigating a minefield with no safe exit, as every policy lever carries the potential for an explosion. If they maintain the status quo on interest rates, they allow persistent inflation to take root. If they cut prematurely, they risk supercharging the inflationary impulse, and if they hike, they may shatter an economy already reeling from a massive energy shock. According to Reuters, analysts foresee oil escalating toward $120 to $130 per barrel if the current conflict persists, while J.P. Morgan has issued a stark warning that prices could breach $150 in the event of a prolonged disruption. At these extreme levels, high energy costs transform from a mere irritation into structural wreckage for household budgets, logistics expenses, and corporate profitability. This is precisely why economists are looking back at the dark years of 1973, 1979, and 2008 as terrifying blueprints, as massive oil shocks are almost always the precursors to recessionary or near-recessionary periods. The current vacuum in the energy market is being described in apocalyptic terms, with Reuters citing International Energy Agency estimates of a 12 million barrel per day supply deficit, making this the single largest oil supply disruption in recorded history. Even a rapid resolution will not provide instant salvation due to the elevator and feather effect. Prices soar as fast as a lifting elevator during a crisis, but they drift down as slowly as a falling feather once the tension eases. Reuters further clarifies that even if oil flows are restored, the economic aftershocks will move through the system with agonizing slowness. While releasing strategic reserves can act as a temporary tourniquet, it cannot heal the underlying wound. What practical steps can you take when the macroeconomy feels like it is unraveling? The reality is that your financial survival depends far more on your own tactical discipline than on accurately predicting global trends. Your primary mandate is to avoid the trap of panic selling. Liquidating your portfolio in a moment of terror merely crystallizes temporary market swings into permanent wealth destruction. If you have a long-term horizon, retreating to cash does not remove risk, it simply trades market fluctuations for the certain erosion of inflation and the tragedy of missing the eventual recovery. Instead, you must fortify your defensive perimeter by pressure testing your emergency fund. Aim for a reserve that covers 6 to 12 months of essential living costs, held in accessible vehicles like high-yield savings accounts. This cash reserve serves as a mental shock absorber, providing you with the necessary psychological clearance to make rational choices when the news cycle turns existential. You must also audit your monthly cash flow before the secondary tremors of this crisis fully arrive. With gas prices already elevated and grocery and travel costs poised to climb, waiting for your bank statement to scream for help is a recipe for failure. Proactively slash discretionary spending today and redirect those funds into liquid savings. Furthermore, for those who invest on a systematic schedule, the most vital rule is to stay the course. It may feel unnatural to buy into a bleeding market, but decades of financial history prove that dollar-cost averaging remains the most effective way to build long-term wealth. The secret weapon of a bear market is that your dollar suddenly gains more leverage, allowing a fixed contribution to harvest a greater volume of shares than during the peak. This volatility is a gift for the disciplined. It systematically drags down your average entry cost, provided you refuse to blink. History shows that the casualties of a downturn are almost always those who pause their contributions, effectively walking away from the table right as the odds turn in their favor. By the time these hesitant investors feel safe enough to return, the most lucrative buying window has typically slammed shut. Maintaining your investment cadence is not about bravery, it is about the cold, mathematical reality that the best long-term returns are forged in the fires of temporary market stress. Success in this environment is determined by your ability to map out your own personal energy battlefield. Every household has a different flank exposed to the current macro shock. If your life involves heavy commuting, fuel efficiency is no longer a luxury, it is a critical defensive line. If you are carrying revolving debt, those elevated interest rates are a direct leak in your balance sheet. For the business owner moving physical inventory, the surge in diesel and freight is a silent tax on every shipment. You must pinpoint exactly where these global pressures are entering your home and execute small, tactical adjustments before those expenses metastasize. This proactive response is the ultimate wedge between households that flourish and those that fail. The true differentiator in financial resilience is not your IQ or the size of your starting capital, but your response time. Data from previous economic shocks proves that the victors are those who adjust while the situation still feels manageable. They are the individuals who prune discretionary spending before the bank forces their hand and build up liquid reserves before the air smells like desperation. They continue to invest through the noise because they value mechanical discipline over emotional comfort. They pay down high-interest debt before it has the chance to compound into a crisis. These are quiet, unglamorous moves that rarely trend on social media, yet they are the only ones that actually work. You are currently positioned in a unique vantage point where the opportunity to act still exists. Most people will remain paralyzed until the damage is already visible on their monthly statements, but by then, the most effective preventative measures will have evaporated. Your anxiety is a natural biological signal, not a failure of character. The error lies only in allowing that fear to seize the controls. The correct response is a silent, methodical audit. Review the integrity of your budget, verify the depth of your emergency fund, and shield your investment process from the headlines. Once you understand your exposure to debt and energy, you must stop consuming the fear-driven narratives of the news cycle. You now understand the waves that are moving toward the shore, why they are delayed, and how to shore up your defenses before they hit. This window for action is still open, though it is for educational purposes only, as I am not a financial advisor and the final outcome rests entirely on your own strategic choices and personal circumstances.